Welcome to the deep dive. Today we're really unpacking a tough question sent in by one of our members. Can Rowe Price, an 88-year-old active asset manager, actually survive this huge structural shift towards low-cost passive investing? This is all about understanding how these legacy giants try to stay relevant.
Exactly. We're looking into TROW's big recent moves. There's a major acquisition, a significant new partnership. We need to figure out, are these like smart plays for the future, or are they just sort of desperate moves against this industry tide?
Right. So our mission today is a proper deep dive into Rowe Price Group, Inc. That's ticker TROW. We're using the closing price from October 8th, 2025, which was $105.82, to really gauge its financial health and its strategic direction.
And, this is where it gets really interesting. The estimates for TRW's actual value, they swing wildly. Some analysis points as low as $91 a share, bearish view. Others are way up at $164, very bullish. That huge gap tells you everything about the conflicting stories here. We'll break down why there's such a divide. And the big question for you listening is TROW a classic value stock, maybe poised for a comeback? Or is it a value trap just waiting to get swamped?
Okay, let's start with the basics. Build that foundation.
Right.
Chapter 1, business understanding. TRW runs on that classic asset management model, right? Something like 93% of their revenue comes from investment advisory fees. It's all based on assets under management, AUM. And the scale is pretty massive. What was it, $1.73 trillion in AUM as of late August 2025?
Yeah, that scale is enormous. It helps a lot when markets are good, but it also makes them vulnerable when money flows out, which frankly has been happening. TRW built its name on top-notch active management, deep research, global reach, the whole package. Over 150 mutual funds.
But the real advantage, the moat, as they say, isn't just the funds themselves, is it? It's where the money actually sits.
That's exactly right. The key here is retirement solutions. About 2/3 of their total AUM is locked up there. Think 401ks, defined contribution plans. These assets are incredibly sticky. Why? Because moving a big retirement plan is a massive hassle for companies and individuals, high switching costs. So that inertia protects a big chunk of TROW's revenue base, buys them breathing room, essentially.
Okay, so if 2/3 of the assets are sticky, why all the talk about pressure? Why are margins getting squeezed? Is that stickiness maybe not permanent?
Well, that's the core tension, isn't it? First, this relentless shift to passive investing is just eating away at their ability to charge high fees. The market keeps asking, why pay you extra if you can't consistently beat the index after fees? It hits their core value prop. And second, the growth areas now are things TRW wasn't originally known for, like active ETFs and especially alternative investments. Think private credit.
Yeah, it sounds like a real pressure cooker. You adapt or you disappear. Our sources are actually predicting pretty significant industry consolidation. Maybe 16% of asset managers could close or get bought out by 2027. So TRW really needs to use that sticky retirement base as a launch pad for whatever comes next. All right, let's move to Chapter 2. Management evaluation. We're talking about a company with deep roots, founded way back in 1937 during the Depression. The current CEO, Rob Sharps, he's been there 28 years. Took the helm in January 2022, right when things were getting really tough with the market downturn and this passive shift.
And it's interesting to see how they're playing it. Management strategy seems to be both defensive and offensive at the same time. On the defensive side, they're really focused on shareholders. TRW is a dividend aristocrat, which is a big deal. That's 38 consecutive years of dividend increases. The current payout is $5.08 annualized. Plus, they're consistently buying back stock, like $83.1 million repurchased in just Q1 of 2024, rewarding loyalty.
Okay, that's the defense, keeping current investors happy. What about the offense, building for the future? That huge bet on alternatives comes to mind. The $4.2 billion acquisition of Oak Hill Advisors, OCHA, back in 2021. That was big.
It was massive for TROW. $4.2 billion. You have to remember, this is generally a pretty conservative company. That price tag was almost half their market cap back then. A really decisive move to get scale in alternative credit fast. And more recently, just September 2025, they announced this new strategic collaboration with Goldman Sachs. It's capital light, which is smart. They can co-brand target date funds, leverage Goldman's private market expertise without another huge upfront cost or risk like OSHA.
But let's talk efficiency. Return on invested capital, ROIC. It's still healthy, 14.7% over the last 12 months. But, and this is a big but, that's way down from the peak of 28.4% in 2021. Does that steep decline maybe suggest their main active management engine is kind of sputtering, making these big pivots less of an opportunity and more like a necessary survival tactic?
I think that's fair, yeah. That ROIC drop really shows how hard these industry headwinds are hitting profitability. The pivots aren't just optional, they're pretty much mandatory because the old way of making money isn't working as well. It feels like a race. Can they transition quickly enough before that core business erodes too much?
Okay, Chapter 3, Financial Analysis. Let's get into the numbers. Market cap is $23.25 billion. Looking back, their revenue and earnings per share have been quite volatile. They peaked in 2021, then things fell off sharply in 2022. And that operating margin compression you mentioned, from over 52% in 2021 down to around 39.8% in 2024, that's significant.
Exactly. That margin squeeze is the direct result of losing pricing power. Fewer clients willing to pay top dollar for active management. But this is where the bull case really gets its strength. The financial foundation. TROW has what you'd call a fortress balance sheet. Seriously strong. The company's basically debt-free. Their debt-to-equity ratio, it's tiny, just 0.4%.
Wow, okay. Debt-free is impressive, definitely safe. But does that maybe suggest they're being too conservative? I mean, if you need to fundamentally change your business, shouldn't you maybe use that strong balance sheet more aggressively to speed things up, leverage it a bit?
That's a valid strategic question, absolutely. Are they being prudent or overly cautious? But regardless, their liquidity position is just, wow, it's kind of staggering. The current ratio measuring short-term assets against short-term liabilities is 10.95. Just for context, most healthy companies aim for maybe 1.5x or 2x. TROW has nearly $11 in ready assets for every $1 it owes short-term.
Incredible stability then. But the valuation seems to tell a different story, almost screaming caution. Their current price-to-earnings ratio, PE, is only 11.8x. That's quite a bit below their own 10-year average, which is around 14.2x.
Yeah, right. And it's not just below their own history. When you compare TREW to the industry giants, especially the passive ones they're up against, the discount is really stark. Think about BlackRock. Huge player, lots of passive offerings. Their PE is way up at 28.4x, so TRW trading at 11.8x. That signals the market is heavily penalizing them for that existential threat from passive investing. There's a lot of doubt baked into that price.
Okay, part 2. Let's look at external forces, starting with Chapter 4, Market Sentiment. What's Wall Street saying? Seems like analysts are pretty cautious, maybe even a bit neutral. The consensus rating is basically hold or reduce, and the average price target, around 104 to 106x, is pretty much exactly where the stock is trading right now, $105.82. So analysts seem to be waiting, yeah.
They're definitely waiting for proof, sitting on the sidelines. But interestingly, the technical charts offer a slightly different angle, kind of a counter-narrative. Short term, yes, the price is flat. It's trading right on its 50-day moving average, which is $105.76. No real momentum there. But the longer-term picture, looking at the 200-day moving average, that tells another story.
Okay, how so?
Well, the stock price is actually comfortably above that 200-day moving average, which sits lower at $98.32. This suggests that despite the analysts' caution based on current weak fundamentals, longer-term investors might be starting to buy into the turnaround story.
Ah, okay. So putting that together.
Yeah, the synthesis here is key. The analysts are looking backwards or at the present moment, seeing the weak fundamentals, the outflows, the margin pressure we talked about, so they're cautious. But that upward long-term trend, that suggests investors are maybe looking forward. They're pricing in the potential success of management's big strategic bets, OSHA working out, the Goldman partnership bearing fruit. The market seems to be giving them some credit for the transformation plan, even if the hard numbers haven't fully validated it yet.
Interesting. Let's move to Chapter 5, Ownership Structure. Who actually owns TROW stock?
Well, it's heavily owned by institutions. We're talking 80–81% institutional ownership. And kind of ironically, the top 3 holders are the very passive giants TRW is competing against. Vanguard holds about 12.0%, BlackRock has 9.4%, and State Street owns 6.6%.
Huh. So the big indexers own a huge chunk. What does that really mean?
That's a bit of a dual-edged sword. On one hand, that high passive ownership provides a sort of stability, a floor under the stock price. These index funds have to hold TROW because it's in major indices like the S&P 500. They aren't selling just because the outlook is cloudy, but on the other hand, because it's mandatory ownership for them, it doesn't really signal true conviction or belief in the turnaround strategy from smart money. They own it because they have to.
Right, it's not an active bet. So where do we look for real conviction? Insiders.
Exactly. You look at management, the directors, they own between 2.2% and 3.9% of the company. And here, the signal is actually quite meaningful. Over the last 12 months, there's been net positive insider buying. Insiders purchased about 213,500 shares, while they only sold around 113,400. Seeing management put more of their own money into the stock while navigating this tough transition, that's generally seen as a pretty strong vote of confidence. They're putting their money where their mouth is.
Okay, that makes sense. Let's talk risk now. Chapter 6. Risk assessment. We can frame this using a SWOT analysis, right? Strengths, weaknesses, opportunities, threats. It seems like the whole strategy is about using their strengths to combat the weaknesses and threats.
That's a good way to look at it. The core strengths are clear. That fortress balance sheet we discussed, the amazing 38-year dividend track record, and that very sticky retirement client base. Those are powerful assets. But the weaknesses are also undeniable. Persistent net asset outflows from their active funds, the ongoing revenue and margin pressure. Plus, they're heavily concentrated in U.S. equities, about 51% of AUM, and have a relatively limited international footprint, less than 10% of AUM. That's a concentration risk.
And the opportunities seem directly tied to addressing those weaknesses. Growth in alternatives through OSHA, expanding into active ETFs, maybe the Golden Partnership helps there too. But overshadowing everything is the main threat. That fundamental structural shift to low-cost passive investing feels almost existential for a firm like TROW.
It really is the defining challenge. The whole situation boils down to a race against time. Can management build up these new growth engines? Alternatives, ETFs, make them profitable and significant before the erosion in their traditional high-fee active management business drags the whole company down. That's the core conflict.
And there are external risks too, right? Macroeconomic stuff.
Absolutely. TROW is very sensitive to broader market conditions. High interest rates, for example, can hurt the performance of their fixed income funds. And general market volatility, often sparked by geopolitical events like, remember the market reaction to those broad U.S. tariffs announced back in April 2025, that can cause AUM to drop quickly, hitting revenue almost instantly.
Okay, so let's bring it all together. Chapter 7. Conclusion. We need to synthesize this and lay out the competing narratives for someone considering an investment. It really comes down to which story you find more compelling.
Exactly. Let's outline the bull case first. It stands on about 4 main pillars. Pillar 1, it looks undervalued based on that low 11.8x PE ratio compared to history and peers. Pillar 2, exceptional financial strength. That debt-free balance sheet and massive liquidity give them staying power. Pillar 3, compelling shareholder returns. It's a dividend aristocrat, consistently returning cash via dividends and buybacks. And Pillar 4, management is making a proactive strategic pivot. They aren't just sitting still. They're actively moving into growth areas like alternatives with OSHA and Goldman.
All right, that's the optimistic view. Now, the bear case. What are the main arguments against TROW?
The bear case is also pretty strong, centered on those core risks. First, the inescapable structural headwinds from the rise of passive investing. It's just a massive drag. Second, this leads to persistent outflows from their core active funds, which directly pressures revenue. Third, the resulting margin compression means they're making less profit on the assets they do manage. And the big fear here is the value trap risk. If that legacy business declines faster than the new ventures can grow, the stock might look cheap, but it just keeps getting cheaper as the business shrinks.
So it really crystallizes that valuation range we mentioned at the start.
Precisely. That wide intrinsic value estimate from $91 on the low end to $164 on the high end perfectly reflects these two competing narratives. And the current price, around $105.82, sitting in the lower half of that range, it tells you the market is still pretty skeptical about the turnaround success. It acknowledges the company's financial strength and stability, sure, but it's not yet fully convinced they can pull off this transformation against such strong headwinds.
So the ultimate decision for an investor really boils down to this fundamental judgment, doesn't it?
Yeah.
Is T. Rowe Price basically a melting ice cube, a legacy business managing an inevitable decline? Or is it actually a resilient, well-managed company successfully using its strengths to reinvent itself for the future of asset management?
That's the million-dollar question, or maybe the multi-billion-dollar question in this case. And it leads to a really interesting thought for you, the listener. Let's say TROW does successfully leverage its research engine. Let's say they deliver consistent, strong performance in these new alternative and ETF products. What happens then to how the market values them? Does that PE multiple just climb back to its historical average around 14x? Or if they really nail the transition, could the market start seeing them as a growth story again, pushing that multiple much higher, maybe even towards where peers like BlackRock trade? Something to think about.
Definitely food for thought. Well, thank you for joining us on this deep dive into T. Rowe Price. We hope this analysis helps you form your own view.
Yes, thanks for tuning in. And hey, if you like these deep dives, please like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority requests for deep dives on specific tickers. We're planning to cover all the S&P 500 stocks over the next few months, and members get that exclusive priority access. If you just want a one-off deep dive on a stock you're interested in, dropping us a super thanks is a great way to do that too.
And finally, the important reminder. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.